Hello and welcome. I am Sylvan Lane, a finance and economic policy reporter at The Hill. Thank you for joining us today for our forum on a topic that is on everyone's minds these days, advancing America's economy. I'd like to thank our sponsor, the American Bankers Association, for supporting today's event. America is experiencing low unemployment and strong consumer spending, yet high inflation and soaring gas prices are creating anxiety. And the pandemic has challenged the economy with supply chain bottlenecks and labor shortages. As the Federal Reserve takes steps to slow inflation, what can consumers and manufacturers expect to see over the next year? Is the threat of recession real? We've got an exciting lineup of speakers joining me to answer these questions and more. But before we begin, a few housekeeping notes. You can tweet us at The Hill Events using the hashtag #TheHillEconomy. We are broadcasting live, and we will be taking your questions throughout the program. Now, we begin our program with a message from our sponsor, the American Bankers Association. Please welcome Rob Nichols, President and CEO of the American Bankers Association. Rob, over to you.
Thanks, Sylvan. We're pleased to be partnering with you and The Hill on this event and excited to see the great lineup of speakers participating today. There's a lot for all of us to process right now. The unimaginable tragedy in Texas and all of the unanswered questions. At the top of that list, what could possibly drive an 18-year-old to enter an elementary school and take the lives of so many children? As a parent, I can't even imagine what those families are going through. They will need far more than thoughts and prayers. We're still coming to grips with the other recent mass shootings in Buffalo and Southern California. It's happening so often, it's getting hard to keep track, which is a really sad statement. We're still tracking the ongoing pandemic, which has claimed more than 1 million lives. And we're witnessing Russia's unprovoked and unjustified invasion of Ukraine and the incredible resolve of the Ukrainian people in response. On top of all of that going on, we can now see economic storm clouds looming on the horizon, the focus of our important conversation this afternoon. It's a challenging moment for the U.S. economy, with inflation running at its highest level in a generation, hitting every American in their wallet. We continue to suffer supply disruptions due to the lingering effects of the pandemic and the Russian aggression in Ukraine. The Fed is moving to slow demand by raising interest rates and pledging to keep hiking until inflation is under control. Still, there are questions about whether the Fed remains behind the curve. Some wonder if Jay Powell and his colleagues are pushing the country towards recession or perhaps poised to deliver an unprecedented soft landing. The recent market volatility tells us not everyone is certain of the outcome. Amid the many questions surrounding the economy right now is one certainty. America's banks remain healthy and ready to continue providing much needed support to the communities they serve, as well as the broader economy. But don't just take my word for it. Instead, listen to the words of the acting FDIC chairman, Marty Gruenberg, who said just yesterday that the banking industry remains strong at this time, with capital and liquidity both solid. The Fed's latest financial stability report released earlier this month also highlighted the resiliency of the banking sector. Among other things, it concluded, banks have maintained risk-based capital ratios well above regulatory minimums, credit quality remains robust, and funding risks at domestic banks remain low after the flood of deposits they received during the pandemic. We also know that bank reserves remain above pre-pandemic levels, another sign of the prudent planning and risk management underway as our industry prepares for potential headwinds. Bottom line, America's banks have weathered the unprecedented storm posed by the pandemic well, and they remain well positioned to navigate the uncertain road ahead right alongside their clients and customers. The Fed report also made clear that the biggest threat to the financial system right now may be the growing number of non-banks looking to offer banking services, but without having to meet bank-like rules. We have some concerns about that. Hopefully today's speakers get the chance to talk about whether fintechs, crypto companies, and other new financial players should have to meet the same rigorous requirements as banks if we want to ensure that consumers and the financial system are protected. Innovation is critical to our competitiveness, but markets are also built and sustained on trust. As Chair Powell has pointed out, we should be guided by the golden rule of financial services. The same activity should be subject to the same regulation. There's another big reason banks are well positioned for the future, no matter what it brings: the 2 million dedicated women and men who work in our industry. From tellers to loan officers to cyber experts and everyone in between, those are the people making sure the world's most competitive and resilient financial system continues to function seamlessly day in and day out. Finally, I wanted to take a moment to reflect on the significance of this particular day for our country. It was 2 years ago today that George Floyd was murdered in Minneapolis. Since that time, our nation has faced hard questions about persistent racial inequities and what we as a country can do to build a more just and inclusive future. The unabashed racism on display in Buffalo just 2 weeks ago is a stark reminder that we have a long road ahead and a shared responsibility to face these challenges head on. That includes the banking industry, where we remain committed to improving diversity, equity, inclusion at every level, not just because it's the right thing to do, but because we know it's good for business and good for the country. Our members believe that a more inclusive economy that opens doors of opportunity for everyone is a stronger economy. As we kick off today's conversation, I hope that's something we can all agree on. Thanks again to the Hill for the opportunity to partner on today's event. Thanks to all our speakers, and thanks to each of you for joining us. I'll turn things back over to Sylvan.
Thank you to Rob Nichols, President and CEO of the American Bankers Association. My next guest is Congressman Patrick McHenry, a Republican from North Carolina who serves as the ranking member on the House Financial Services Committee. Welcome.
Great to be with you.
So, Congressman, I want to jump right into it. What are the top economic concerns that you're hearing from your constituents right now?
The cost of goods, the availability of goods, price of gas at the pumps. Those things are really the driving force of the discussions I have at home in North Carolina and when I travel across the country. People are concerned about rising prices and inflation, and they've got different markers of what they're concerned about, of specifically what they're concerned about. But it's rising prices generally, and the impact that this administration has had on increasing inflation and their inability to actually tackle the issue and bring relief to the American people.
So what should the White House and Congress be doing to fight this inflation?
Sound money. That means a dollar saved today should be a dollar saved tomorrow. And a return to fiscal conservatism. This government spent more in the last 2 years than in any period in American history. And so we need to rein in federal spending. We also need to work to ensure that we match the workforce with the jobs that are available and the needs of employers. We have a workforce, we have 5.5 million folks looking for 11 million open jobs. So we have to make sure that the skills are matched with the availability of jobs in the marketplace. And we need to make sure that we tackle these issues in a bipartisan way to bring our the availability of workers matched with the available jobs, and at the same time making sure that we bring our supply chain closer to home and with our trusted allies. And I think we can do that. This administration is yet to put forward a serious proposal to do this, but I think that's necessary work of the next Congress.
And speaking of that, there's a pretty solid chance, according to election experts, that Republicans could take control of the House of Representatives next year. The Senate as well, potentially, but in either case, they'd still be working with the Democratic White House. What are bipartisan ways that you think both Democrats and Republicans could potentially get on board with fighting inflation before we get to a point where it might go out of control?
Well, I think the Fed is doing a strong job, a good job, and Jay Powell's leadership at the Federal Reserve is well equipped to tackle the issues of inflation. So I have confidence there. And Secretary Yellen has great experience as well, and I hope that we work with them in a bipartisan inflation under control. For next Congress, I think we can look back 10 years ago when we saw the passage of the Jobs Act with a Democrat Senate, Republican House, and a Democrat White House. Divided government actually forced us to compromise, to bring on the necessary work of legislating. And it's my hope that we can take that experience from 10 years ago and bring it to the needs of today. The job matching, that is a workforce development issue. It certainly deals with tax policy. It certainly deals with capital markets issues as well, so that we can link up capital with labor and make sure that folks that are working to build companies get the equity in those companies. We also need tax policy that encourages work. And we need to ensure that workforce development programs actually match the needs of today. Those things can be done in a bipartisan way.
And, looking at the overall impact that these different challenges facing the economy are having, over the past few months, we've seen some volatility in the stock market. We've seen cryptocurrency values go down quite a bit. And there's growing concern among, Americans, just average, Main Street folks and on Wall Street, that we could be in a deeper downturn in financial markets as the Fed continues to fight inflation and questions are raised about the strength of the economy. How concerned are you about the resilience of the financial system as the U.S. heads into these challenges?
I think the financial system, we're the envy of the world. We need to ensure that global capital can find a safe haven here in the United States. The rule of law is abided by, that our system of government is respected. Those are the things that will bring capital here to the United States. And the resiliency of our market is built around it being an open market. In addition to that, I think that we need a well-regulated space for capital to come into the cryptocurrency or digital asset ecosystem. That means we have to have clarity under securities law. That means we have to have a well-regulated stablecoin regime. And we have to get on with the business of legislating in this realm to make sure that we can bring global capital here to develop Web 3.0. Digital assets are the foundation of the next generation of internet technology. So I think those are ways that we can bring resiliency and safety to our marketplace, and especially in this midst of quite a bit of turmoil in the capital markets and in the digital asset marketplace as well.
Now, Congressman, you were among the first members of the House to really start to seriously grapple with the rise of cryptocurrency and what it could do for the financial system. And looking ahead, if the House does flip to Republican control next year, you are in line to chair the Financial Services Committee. As you try to lead the process of developing a stablecoin or a cryptocurrency framework, what are the main principles you think Congress should follow when figuring out how to adapt or create new regulations to keep consumers safe but also help crypto thrive?
Well, the first step is a federal regime for stablecoins. Right now, we have left it to the marketplace to determine what is an alleged digital dollar. I think we have to have a well-regulated regime around something that purports to be a U.S. dollar, and is incumbent upon the federal government to do that. And it's necessary for us to legislate here. I think that means you have to have high-quality liquid assets backing stablecoins. If you're going to say that you're a U.S. dollar, it needs to be backed by something that is very close to a U.S. dollar. In addition to that, we have to acknowledge the work that states have put in. New York has a well-regulated stablecoin regime. It is the best in the United States. So I think we have to build off the work of the states. So that's part one, is a regulated stablecoin. Part two is defining a digital asset. What is neither a security nor a commodity? What is that separate space that is a distinct property called a digital asset built on an open, permissionless blockchain? Number three, we have to regulate the exchange of digital tokens or digital assets, and the mechanisms to exchange those things. And number four, we have to understand the consequences of central bank digital currency. That means we have to balance consumer protection and the needs of the American people with a very complex set of regulations necessary to balance our banking system and the needs of the American people.
Now, when it comes to crafting this cryptocurrency regime, obviously there's a bit of a learning curve for folks when it comes to cryptocurrency, where it fits into the financial system. How well do you think most of your colleagues in Congress understand cryptocurrency?
Well, look, we're all learning. And I think I've spent a lot of time around digital assets and cryptocurrencies, and every day I'm learning something new. And so we have a lot of policymakers that are wrapping their heads around the changing nature of this digital ecosystem. And I welcome that. I think it's a great thing that policymakers are grappling with this. And they're trying to keep up with their constituents. Federal Reserve had a stat release that something close to 15% of the American people have owned or exchanged or dealt with a digital asset last year. And so that is growing tremendously year over year, and policymakers are trying to keep up. I welcome it, and I think it's high time Congress gets their mind wrapped around it. Final thing I'll say here is this. This is a lot like the advent of the internet 30 years ago. Congress understood a little bit, but was very slow and very measured in how they legislated, because they didn't want to be wrong, and they knew it was the future. Likewise, digital assets are the future, and we don't want Congress to be wrong about this. So we would be quite measured about how we legislate here so that we can bring innovation here to the United States and allow innovation to be the driving force of the U.S. economy for decades to come.
Congressman Patrick McHenry, ranking member of the House Financial Services Committee, thank you so much for joining me today.
Great to be with you.
My next guest is Senator Sherrod Brown from Ohio. He is the chairman of the Senate Banking, Housing, and Urban Affairs Committee. Welcome, Senator Brown.
Good to be with you. Thanks, Selman.
Thanks. So I wanted to kick off by asking you a pretty simple question. What are you hearing about the economy and how good or bad it is from your constituents?
Well, people in Ohio recognize that we have strong economic growth, and people even occasionally will say, we've heard our GDP is growing faster than China's. That's the good news. The bad news is people are very concerned about inflation. And people in Ohio understand they understand the betrayal of American corporations having, that companies for a generation and a half now have scoured the globe looking for low wages. And first they went to Alabama, they shut down production in Ohio and go to Alabama. Then that wasn't cheap enough labor. Then they forced through a trade agreement with NAFTA with Mexico, and that wasn't cheap enough labor. And then they'd move overseas to China. And we're paying the price for that as those companies betrayed us. That's a big part of what's caused inflation now. It's a big part of why home builders couldn't find lumber and we couldn't get enough we couldn't get enough semiconductors, and semiconductors invented in this country, and only about 10% of them are made here now. Light bulbs invented in this country, LED bulbs, 99% of them are made in China. You can just list the number of components manufacturing. And we were a country that made things. Ohio absolutely has always been a state that's made things. But people recognize what corporate interests have done lobbying their Congress and their presidents and betrayed workers in so many cases.
Now, speaking of making things in Ohio, I know you and your colleague from Ohio, Senator Rob Portman, just hosted President Biden recently in your home state. Can you tell me a little bit about why President Biden was in town and what your goals are working with Senator Portman on your innovation legislation?
Yeah, he recognizes that, President Biden recognizes that Ohio is, if not the number one manufacturing state in the country, certainly the top two or three. He also has recognized that we are now burying the term Rust Belt. I used that term with him a couple of months ago during the announcement of the Intel expansion into Ohio. He mentioned it in the State of the Union that we're burying Rust Belt, the term Rust Belt. How we're burying it with Intel, we're burying it with NASA Glenn and Cleveland, we're burying it with manufacturing, the manufacturing camps in the America Works manufacturing in Youngstown and in Dayton and Cincinnati. And he was there to point that out, to celebrate that, and to show that we are going to make that there's going to be a real focus on making things, and it really is putting workers at the center of our economy. For years, unfortunately, under presidents of both parties, from George Bush Sr. up through Trump, corporate interests ran this government. And for the first time, we have a president that's putting workers at the center of our economy. And we have a Senate now that's doing the same. We still recognize corporate profits are the highest since 1950. We recognize that CEO pay has just exploded upwards while most workers' wages have been flat. We recognize that many companies, especially oil and pharmaceutical and shipping, and meatpacking, have used the pandemic to jack up their own prices way higher than inflation. So that's in part what's driven inflation. That's not the whole story, of course, but all of those things are coming together in a way that we've got to start putting workers first. We start focusing on inflation. We start focusing on those industries that have especially violated the public trust.
And when it comes to fighting inflation, there's only a few months left before we start to really get into the midterm election season, when legislation tends to grind to a halt in Washington. I was wondering if there's anything that you think that President Biden, in cooperation with Senate and House Democrats, can still do at this point to bring prices down.
I think the most important thing we do, the Federal Reserve is obviously involved in that. I think the president needs to use the bully pulpit on those companies that have especially violated the public trust. And, using one CEO bragged about good pricing momentum. He should be called out on that. It's a CEO that talking about this is our opportunity to raise prices even more and to make even bigger profits. As I said, biggest profits since 1950. We do a windfall profits tax where we rebate directly to consumers. One of the things we do on the Innovation Competition Act is it's about making things in America, and we want to show with the infrastructure bill, with this legislation, the competitiveness, the Innovation Competitiveness Act, that we focus on manufacturing and focus on making things here.
Now, speaking more about making things in America, I know housing has been a big priority of yours since you took over the chairmanship of the committee. And I wanted to talk to you a little bit about the, ambitious proposal that President Biden and Democrats came out with to expand affordable housing. That was linked to the president's Build Back Better plan. And as I'm sure you know well, there's a little bit of uncertainty about whether or not that's going to move forward. Do you think that there's a pathway to making some sort of progress, whether through a reconciliation bill or through a bipartisan measure, to really kind of tackle the shortfall of affordable housing we have in this country?
Absolutely. I just spoke a moment ago I met with the Federal Home Loan Bank Board out of Cincinnati. And they're a three-state entity, if you will. They're made up of bankers and public members also, and their focus is founded by Herbert Hoover, of all people, right before Roosevelt took office, and it's made a difference in helping provide more affordable housing for people. And these were some very small towns like Adams County on the Ohio River. One woman was from Cleveland. So we're people from sort of all parts of the state and all demographics of the state. And we've got to focus on constructing affordable, accessible housing for people. We haven't done that enough. What we were doing in that former proposal is part of this. But I think as we begin to bring supply chains back home, we begin to make more in this country. You will see the focus again return to housing, which is everything from building wealth generation to generation to providing just a decent place for kids to be raised and go to school. It all starts with an affordable home.
Certainly. Now, I want to shift gears a little bit to another part of the committee's beat, which is financial markets. I know you've been very, very concerned over the course of your career about investor protections, consumer protections, making sure folks know what's going to happen to their money and know what's going on with it. And over the past few years, we've seen a very large influx of Americans into the stock market, into cryptocurrency markets. And over the past few months, we've seen a lot of those values start to shake up a little bit, a lot of turmoil in markets. Do you think that Americans right now are well protected against the potential risks of a deeper financial downturn?
I think we have done a reasonably good job recently in making sure that banks are well capitalized. I've pushed the Federal Reserve and the controller of the currency and the FDIC and other regulators to pay more attention to that. I think in the Trump years they were pretty lax, but now those regulators understand that that there's not going to be another bank bailout. I think in the Trump years there would have been another bank bailout, frankly, because that president would have wanted us to do that if there had been a problem. They're better capitalized, but in many cases they're not strong enough. We have to, we see things like companies continuing to do stock buybacks, continuing to reward their executives. It used to be 25-1 executive compensation versus as a ratio with average pay of that company, and now those numbers are almost a factor of 10 times that, in some cases 250, 300-1. I think we use whatever mechanism we can to make sure that this economic growth is shared by everyone, and it hasn't been in the last 20 years in this country. And my commitment has always been to turn that around.
Senator Brown, Chairman of the Senate Banking Committee, thank you so much for joining me today.
We'll do it again. Thanks very much, Sylvan.
My next guest is a pioneer in the tech and software industry. Welcome Chitra Balasubramanian, the Chief Financial Officer of Circle CI. Circle CI empowers software developers and moves innovation forward. Chitra, thank you so much for joining us this afternoon. I wanted to ask you first and foremost about the challenges that your company is facing in this rocky and uncertain economy.
Well, thank you for having me. I would start by saying, similar to many companies in the world today, we are navigating through a lot of changes in, how people work, moving to more of a remote and distributed working environment, ensuring that, we have access to the great talent that's required to really drive business forward. I would say we're fortunate to be playing a central role within the software industry, as this is something that I know a lot of companies are thinking about today, given the important role that software plays in driving the economy forward.
So when it comes to, the unique role that software plays in the economy and the very uncertain circumstances that we're kind of navigating right now, I wanted to talk to you about, what's been important to you and your company's success in trying to make sure that you're accounting for all the different risk factors and all the, ways that the pandemic has reshaped the way that we do work across the world.
Yeah, actually, I think if anything, the pandemic has sort of sped up the urgency around really leveraging software for the economy today. Ultimately, it plays three very important roles if you, think about it. It helps people become more effective at their jobs by being able to reduce the need for, mundane, repetitive tasks, and instead to focus on critical thinking and solving problems that are, otherwise hard to do without that time and focus. And, this is particularly important in the current macroeconomic environment where there are a lot of challenges in accessing talent, just given the supply of labor and the constraints around that. And so being able to really reduce the sort of level of undifferentiated work and mundane activities is critically important. And software does play an important role in that. But it also is important for the economy, given that it's allowing creators, builders to really build massive companies that, will fuel our economy both today as well as in the future. And given the sort of way that the economy is today, the way consumers behave today, it really is sort of that first touch experience for most customer experiences. And so companies at large really do need to think about their own business differentiation and being able to create the best possible experience for their customers in order to thrive in this economy, in order to continue to be sort of a lasting sort of company within the global economy today.
Right. Now, I also wanted to touch on a point you made about, companies launching and growing and expanding. You spend a lot of time in the entrepreneurial space, and I wanted to ask you if you think this is a good economy, given inflation, uncertainty with the war in Ukraine, so many different question marks right now. Is this a good economy for entrepreneurs to get going?
Yeah, I mean, that's a great question. I do think there are a lot of different forces at play right now that are causing, many reactions, conflicting reactions in the macroeconomic environment. Let's just remember we've been on sort of a 12-year bull run where hundreds of billions of dollars plus companies have been created and supported. I'd say that, being an active angel investor and just member of the community of entrepreneurs, I can tell you that while valuations and such have changed, there's still a ton of activity at the pre-seed and seed stage sort of financing phases. For that class of investors, their time horizon is pretty long, if you think about it, 10 plus years. And so there's still a lot of capital in that asset class from newer funds that need to be deployed. And so I think while the bar has gotten higher from the standpoint of ensuring that you're creating products that have that really solve real problems and aren't just sort of PowerPoint ideas, I think that getting funded and being able to start great ventures is still a very, very possible thing right now. And in fact, something that I encourage a lot of entrepreneurs to look at, because the environment is still quite good for new business.
And speaking of that environment, I know that you also mentor young female entrepreneurs who are trying to break into the tech space. And I was wondering, from your perspective as both a successful executive in this field and someone who's trying to bring more female entrepreneurs into the field, what needs to change or be done to help make that possible?
Yeah, I'll start by saying, I am, as grateful as I am to be on panels such as this and interviews such as this. I have been very lucky along the way to be supported by great bosses, advocated for. And I think that is a really critical effort that's required in order to bring additional women into leadership roles, right? At some point, I do think it's interesting to ask the same question of folks who are up and coming, because, there is an element of survivorship bias, if you will, in asking women who've sort of made it to the leadership levels. But generally in my conversations with team members as well as others within the industry, it's really critical and helpful to provide mentorship, allyship in a structured sort of systemic fashion in order to really bring that culture into play in a pervasive manner to elevate more folks, give more opportunity to women at large.
And, if you're a man who, works in an industry who, may have an issue in terms of gender balance or wants to take a more proactive role in trying to be an ally to up and coming female entrepreneurs or, employees in any space, what should they be doing and thinking about?
That's such a great question. I think that one is ensuring that space is created for folks to have experience, to have learning opportunities, to take on more than maybe they would have in their role up until that point. I think there's a little bit of that allowance that's required and a little bit of trust to ensure that people get the opportunities to do more and act and grow in their careers. And I would also think, aside from ensuring folks internally within organizations are able to take on more and more responsibility, I would say, from a hiring perspective, being disciplined around ensuring that you have, a broad range of individuals that you look for within your sort of sourcing process and stage of interviewing, I think is very critical. Ensuring that you have a diverse reach geographically helps, but as well in terms of experiences, I think that's something that is a discipline and something that needs to be proactively done by folks looking to broaden their workforce.
Certainly. And, zooming out a little bit too to, the broader state of the economy as well. We're calling you from Washington, D.C. And I was wondering if there's anything in the public policy realm that you think could be helpful in terms of bringing more balance to the workforce, whether there's something Washington could do that might make it easier for everybody to have kind of a jump up to get to where they want to be career-wise without having to make as many other sacrifices along the way.
I love that question, and I think that, industries are at different stages within being able to sort of help and support people across the workforce. I would say, if you think about the tech industry, where I have quite a bit of experience, it's been able to do a pretty good job in providing flexibility to workers in the new environment that we're in, right? Not necessarily having to be back in an office 5 days and being able to balance sort of home and work responsibilities with more flexibility. I would say that while the tech industry has done a great job in this, I think there are a lot of industries that have still ways to go, either because of necessity or tradition, in order to provide that level of flexibility. And I certainly think this is an area where there could be policy support and even assistance in ensuring that we've got the right types of, childcare options and, other things like that are cost effective to help people be able to manage both the work responsibilities as well as the home responsibilities in an area where you may not have the immense flexibility that comes with technology industries.
Chitra Balasubramanian, Chief Financial Officer of Circle CI, thank you so much for joining me today and sharing your perspectives with us.
Thank you so much, Sylvan.
My next guest is Michael Groeninger, co-founder and CEO of Chain Analysis. Chain Analysis is a blockchain analysis company providing leading anti-money laundering solutions for cryptocurrency businesses, financial institutions, and government agencies. I recently sat down with them. Take a listen. Michael, thank you so much for joining us today. I'm really excited to talk to you about some of the developments that we've seen in the cryptocurrency space and the role you and your company play in all of that. And just to get started off the top, over the past few years, we've seen this explosion of interest in cryptocurrencies, both in the amount of them in circulation and the different products being offered. Why do you think we've seen such a drastic jump in just the past couple of years?
So I think the way that I usually look at crypto is that we are basically building an operating system for finance. And finance never had one. And now we see that it's possible to build and recreate and innovate in new ways financial instruments that we never had before. And also, as I said, copy other existing financial instruments and put them on chain. And that means that we can lower the fees, we can lower the cost to build those instruments. And it creates a lot of financial opportunities. And we already seen some of that, for example, with DeFi, where that has been a core driver. We've seen it with representation of ownership, initially in the digital space with NFTs. And there's two sides of driving this. One of them is, of course, like the actual new instruments that you can gain access to. And also, you here is everyone. It's not tied to a small group of elite investors that are high net individuals and so on. It's basically everyone in the world. So it also creates like something that we've never seen before in the world where everyone have access to finance. And then of course there's at the same time, I believe that this will only grow. So I better get into it now. And that's why a lot of retail as well as like established institutional investors want to enter the space.
I'm really glad you mentioned that last part because we've seen, a lot of different financial firms, a lot of different companies get into this space, largely because of the, huge amount of consumer interest. But, obviously over the past few days, we've seen quite a bit of volatility. And, like any investment product, whether it's a stock or a bond or anything, there's always a certain amount of risk and due diligence that somebody needs to take before they jump in. You've been in this space for a while, so if, for someone who might be thinking about how they want to get into the crypto space, what do you think is important for them to keep in mind as they're navigating this really broad world of options?
So I think step number one, it's high risk, right? We are entering a market that's high risk. Even it's today, I think it's a good reminder to say, I know last week or so, it's a good reminder that the established stock market is extremely volatile. A lot of things can happen. We look at it as something that is destined to grow and take small corrections. But if you look at a lot of the companies that gained over COVID the last 2 years, they basically got erased all their gain on the equity side in a matter of a week. And I think that that's an important learning lesson. So if you invest anything, be sure that you do this with the mindset of long-term gain, 10 years. You need to be able to afford to lose all the money tomorrow. So think about it that way, and then build a strategy about what you're doing. Don't react to the market. Then you're never going to win or beat the market. Build a strategy, do what you think you like. And I would say, from my personal opinion on picking shares, I pick what I use myself and I love to do. And then I believe that will grow. And if it doesn't, well, I still try to support something that I love. And I think that's the most important piece when you lose money on something and you need to get to peace with that.
For sure. Now, thinking about some of these public policy issues too, for the longest time in Washington, one of the main concerns about cryptocurrency is how it could be potentially used for money laundering, financial crimes, sanctions evasion. But your company plays a pretty interesting role in trying to stop that. And I was wondering if you could, talk to me a little bit about what you do.
Yes, so what we do at its core in Chainalysis, we've developed an algorithm that are able to go through billions of transactions in a blockchain and basically sort them into groups of, this is one entity, this is another entity, this is a third entity, and they're interact and then identify the interactions with those. On top of that, we gave names to a lot of the entities out there. So it also means that we are able to empower government agencies to follow the money. So basically conduct a follow the money investigation in the digital world. And then through our attributions and through collaborations with the industry, the agencies are now able to find identifying information for individuals. And that could be, for example, be connected to a ransomware attack. It could be connected to terrorist financing. It could be other kind of drug trafficking or human trafficking that would be identified that way. Chainalysis works today with more than 150 public sector agencies in more than 35 countries in the world. So we have a very broad reach. And I think that's an important piece because crypto is global. And in order to solve cases on a global scale, it's really important to be part of that network, be able to share data with others, and be able to conduct these investigations.
So when you go about these investigations, a lot of folks, they heard of a blockchain, they've heard of a cryptocurrency, but they may not be so sure about how they connect with each other. Can you tell me about how exactly you could go down a blockchain or throughout a blockchain to find where certain money is going, or if a certain someone who should not be involved in a transaction is?
Yes. So it's again back to being able to attribute the different transactions. So if you look at a blockchain, think about it as a spreadsheet with 3 columns: sender A to receiver B, and then on top of that, there's a value in the last column. And then there's just a billion rows, and basically all of that is public. But the thing that's not public is that I don't know who sender and receiver is. I can just see they have like basically a random number in front of them. What Chainalysis then does is basically identifying those random numbers and group them together. And that now means that we can put labels on each of these transactions by doing so. So now I can say, oh, this transaction came from this exchange. I know what exchange it is, and it's operating out of Singapore. Now I can see that it was sent to a ransomware provider that Chainalysis, a ransomware campaign that Chainalysis identified. So now we know this is a ransomware payment. And that can be used further on. Then when it received the ransomware, like a collector, the ransomware operator or attacker, then we can see like a few weeks later, they're trying to exit those funds. They might now send them through a mixer and try to obfuscate it. We might be able to look through that one. On the other side of that, they might send it to an exchange. And now on that exchange, we can go and ask, or law enforcement can go and ask, who deposited those funds? Because we have a suspicion that this might be the ransomware campaign owner, and now that person can be identified.
Now, when it comes to the broader public policy picture too, sanctions, evasion, and financial crimes is just one part, but there's also a lot of concern in DC about how cryptocurrencies fit into the framework that the federal government has right now for stocks, commodities, other investment products. And I was wondering, what you think lawmakers and policymakers should be focused on as they're trying to get a sense of how to write rules to make cryptocurrencies safer and more reliable and transparent.
So I think the way to think about this is always to think about it long term. What is the direction that we are taking? If you go back 50 years or so, then financial instruments and the stock market and securities and so on was kind of reserved for the few. And that was part of the technology, how you could market them, how you could basically buy and sell them. You might needed a piece of paper to actually record that someone bought something. This has changed completely. All of this can move way faster today. And you see like platforms like Robinhood and so on, retail investors are already trading fractions and stock and so on, and get access to financial instruments in a way we never seen it before. And then what happens when the price of creating these financial instruments is going down? That means that you will see them applied to way more use cases. So for example, one of my favorite examples here is that we've seen that in the past, we have a secondary market for theater tickets. Is that actually a security? Well, no one really cared because that market was relatively small and well understood and was not connected to the rest of the market. But if you move that on the blockchain and we start to resell a lot of things secondary, then it becomes securities and it's marketed that way. And then the question becomes, is this good or bad? Is it actually serving the right purpose? Are we moving things in the right direction? For the secondary market on theater tickets, it's totally fine and it's good. And it might be the case for many things. So maybe we need to think through, are the rules that we are creating or applying from the old world the same that we should apply in the new world? And I think that's the right way to think about it and try to analyze the why and what are we actually looking for here. And there might emerge like 2 or 3 new categories that we haven't seen before.
Right. Well, Michael, that's all the time we've got today, but thank you so much for sharing your insight both on the past and the present and future of crypto. And it's been great to speak with you today.
Great to be here. Thank you so much.
President Biden recently said fighting inflation is his top domestic priority. David Cayman, Deputy Director of the White House National Economic Council, is here to talk about the administration's plans to boost the U.S. economy. Welcome, David.
Thanks for having me.
Our pleasure. So, David, I wanted to ask you a question right off the top. How strong is the U.S. economy right now?
The U.S. economy is at a point of transition. We're going from the fastest economic recovery in history to what should be stable, steady growth looking ahead. Now, it's important to remember where we started when the president took office. At the time, 20 million Americans were on unemployment insurance. We've seen since then that fastest recovery in history, historic gains when it comes to the labor market. Right now, 1.3 million Americans are on unemployment insurance versus the 20 million that were on when the president took office. We now need to build from that. And in fact, when you look at economies around the world, the US is expected to outperform. When the IMF looked where the economy was expected to be at the end of this year, it found that the US economy would be significantly larger than the economy pre-pandemic and outpace the other G7 countries that we often compare ourselves to. Now, with that said, we do face real challenges. Countries around the world do. There are real headwinds, and obviously a central challenge right now is inflation. That's why the president has put it as a centerpiece of his agenda, given the economic recovery we have had, to fight inflation and to bring down those kinds of price increases we have seen here and around the world. Now, as we do that, and as we transition to that stable, steady growth, it's important to remember that we're not going to see the kinds of job gains, the historic job gains, and historic economic growth we've seen over this last year. That's to be expected. But what should also be expected, what the president is aiming for, is not just a return to the kind of economy we had pre-pandemic. Too often, workers weren't seeing the kinds of raises they deserved. And that's why the president is focused on building an economy that works for everyone and drives the kind of historic recovery we have seen into continued job creation and wage growth looking ahead.
Now, when it comes to taking that rapid recovery and transitioning into a more stable, sturdier pace of economic growth and job gains, what specifically is the administration doing to bring down inflation, which is, front of mind for every American family right now?
Yeah. So as the president has said, given where we are right now after the kind of historic recovery we have seen, fighting inflation is his number one priority, and building on the kind of economic recovery we have seen. He is doing that through a four-part plan for addressing inflation. First is the Federal Reserve. He has appointed respected bipartisan members to the Federal Reserve, and unlike in some prior administrations, he will fight to defend the independence of the Federal Reserve as they do the job they should to meet their dual mandate of full employment and stable prices. Second, he's focused on bringing down costs for families. That includes fighting the kind of inflation we've seen as a result of Putin's actions in Ukraine, for instance, the historic release from the Strategic Petroleum Reserve, and negotiating with countries around the world to have the largest release from their reserves to help address the price increase at the pump. That also includes working with Congress to try to address costs like childcare costs and energy costs, where families deserve relief. A third part of the plan is expanding our economic capacity, because expanding our economic capacity can reduce price pressures. That includes, for instance, childcare, which I just mentioned, helps bring people into the labor force. It also includes a plan the president just rolled out when it comes to housing, expanding our housing stock to try to make it more affordable. Finally, the fourth part of the president's plan is reducing the deficit. This year, we have seen historic deficit reduction. The deficit this year is expected to fall by more than $1.5 trillion, the largest single year of deficit reduction on record, after it already fell in the president's first year in office. So, when you put that all together, that is the way the president is trying to build from the kind of historic recovery we have seen so far to the sustainable and steady growth that Americans deserve looking ahead.
And you're speaking of that process, what exactly is the White House using to measure the success of these plans on fighting inflation? Are you looking for, a decline in prices, or is there another way that you're gauging the success of your efforts to make this economy more inclusive and more encompassing?
Yeah, so, look, we look at a variety of measures that tries to get at how American families are doing. Are they getting ahead? Now, it's important to remember that, since the president took office, families have actually seen real income gains. Their incomes have been going up even relative to inflation, with the largest gains, in fact, coming, at the bottom of the income spectrum for some of the most vulnerable, where those kinds of job gains I was just discussing have actually driven income growth when you look at, even just the amount people are taking home from wages and their investments. That has been going up. At the same time, we know that inflation is taking a real bite from families' incomes. It's why the president is so focused on addressing it and making sure that looking ahead, we continue to see that kind of real income growth that's so important, which is why the president has now made addressing inflation his number one priority, and why he's doing it with all the tools at his disposal, to address families' costs, to expand the economic capacity of our economy, and also reduce the deficit.
Now, what are some of the concerns or some of the obstacles that, might come up during the, efforts to bring inflation down? We're dealing with a very complex global situation with supply chain malfunctions. The war in Ukraine, along with its horrific human toll, has also had a lot of economic chaos left in its wake. What are some of the concerns and obstacles that the White House is looking at as it tries to guide this economy to a more even-keeled pace?
Yeah. So, the economy obviously faces a set of risks. Now, it's important to remember that, over, the last year and a half since the president took office, we've seen the economy outperform what many people expected when the president took office. For instance, when it comes to those job gains and the unemployment rate, that has gone down at a far faster pace than the outside experts even expected. And that's due to the president's policies. But, there are challenges here and around the world. Obviously, the pandemic itself has presented a continued set of challenges as we face, waves from COVID that have continued to affect the economy and also our supply chains. Now, the president has been focused on trying to address that, obviously with fighting COVID being a key priority, which the president has done. That is part of the reason we've seen the kind of recovery we have, and also have begun seeing signs of an economy transitioning from a COVID economy to one where you can have that kind of stable, steady growth, where we see a shift, for instance, from goods demand to services demand that can help normalize our economy. At the same time, we also have real challenges, as you were saying, when it comes to Putin's actions in Ukraine. That is driving higher prices when it comes to energy and food here and around the world. Now, the measures the president has taken with allies and partners around the world are imposing far greater costs on Russia than they are on the rest of the world. But there are costs, and the president was clear on that from the start, and that's why he's doing everything he can to mitigate them, including, for instance, when it comes to energy, negotiating the largest release from reserves from other countries, as the United States did the largest release in its history at 1 million barrels a day for 6 months, as well as actions like allowing E15 use over the summer, which can save consumers 10 cents on a gallon.
Now, David, we have an audience question for you from Bob Meyerson. We'll play the tape for you now.
Hello, my name's Bob Meyerson. I'm chairman of 2 banks and a holding company in exurban and rural Minnesota. My question is, how do you handicap the odds of A, little change in the economy, B, the economy solving the supply chain issues and inflation, and C, recession? Thank you.
Sure. Thanks for the question. Where we're focused is first that the policies we have put in place have put the United States in the best position possible around the world for addressing some of the challenges we face here and in other countries. So as I was saying, the United States is actually expected, according to the IMF, to outpace the rest of the world this year when it comes to growth relative to pre-pandemic. And we're also focused on doing everything we can to mitigate and address some of those risks that the economy faces. That's why the president has a plan to drive growth forward and address inflation. That's a plan that, of course, as I was saying, involves first respecting, putting good people at the Fed who are bipartisan, respecting their independence, addressing families' costs, expanding our economic capacity and reducing the deficit. In the end, where the president is focused is doing everything he can to address risks facing the economy. And it's by taking those kinds of actions the president has helped put our economy in the best possible position looking ahead as economies here and around the world face those kinds of risks from things like COVID and also Putin's actions in Ukraine.
David Cayman, Deputy Director of the White House National Economic Council. Thank you so much for joining me today.
Thanks for having me.
My next guest is Jason Furman, former chairman of the Council of Economic Advisors under President Obama, and now an economist at Harvard. I sat down with him recently. Let's take a listen. Jason, thanks so much for joining us today. I know there's a lot of questions we all have about the economy, so I'm going to jump right into it. Inflation fell a little bit in April, but it's still near 40-year highs. And, we still saw the prices of food, healthcare, transportation continue to increase. What needs to happen for inflation to start coming down in a way that families will actually start to feel?
Look, I think there's some ways that it might already be coming down that families will feel, which is the price of gasoline is likely to fall. The headline inflation number, the 8.3, is boosted by some genuine transitory factors. The problem is that underlying it, there's still a lot of inflation that isn't transitory.
So speaking about the inflation that isn't transitory, there was an expectation among a lot of economists last year that some of the pandemic related reasons that prices were going higher, the shortages that we all remember, supply chain disruptions and delays, those would fade, but that hasn't really happened yet. And I was wondering if, maybe policymakers made a mistake by anticipating those pressures to go away before they actually did.
Yeah, look, I think policymakers last year had a good list of reasons why inflation might go down, but then no list of reasons why it might go up. And so they're living in a world where if everything goes perfectly, here's why inflation will fall. Not everything went perfectly. In fact, some things went quite badly. The Russian invasion of Ukraine, which is tragic for many reasons, but has also raised US inflation. But look, things like, for example, last year people said, oh, all the inflation is in goods. If the goods inflation goes away, then inflation will go away. Well, the goods inflation has gone away, but now we have services inflation. And so you can't just assume, some bad things are going away without thinking, oh, wait, maybe some other shoes will drop and that'll take things the other way.
And why is it that services are, getting a lot more expensive now? As you mentioned before, earlier, in 2021, most of the inflation we saw was in manufactured goods that were, either held up in supply chains or relied on things like computer chips that were in short supply. Why have we seen the prices of, basic goods and services increase so quickly over the past year?
So services are largely produced by labor. The main cost of producing services is wages, and wages are rising very quickly. And so services is where you most clearly see the wage price. It's sometimes called spiral. I like to call it wage price persistence story taking place. The other thing is a big part of services is the cost of housing. And we've seen the huge increase in house prices, the huge increase in rents that's finally starting to show up in the government statistics too.
And when it comes to tackling these sources of inflation, obviously the Federal Reserve is kind of the front line of the inflation fight. The Fed has raised their interest rate range by 0.75 of a percentage point already, and that's likely to keep going up. But there's, broad agreement, even among Fed officials now, that they waited too long to begin raising rates. At this point, can the Fed still curb inflation without causing a recession?
I don't know. I think it's worth trying. I think we might get lucky. I didn't expect all the positive stories to break in the optimistic way people thought last year. I still am not that optimistic, but I think it's worth trying. And that's basically what the Fed is doing now. They're trying to bring rates to neutral and hoping the inflation goes away. I think that's a reasonable strategy. It probably is not going to work, but can revisit it 6 months from now, 9 months from now, if it doesn't work.
And speaking of, whether or not that works, there's, obviously a lot of discussion about the Fed trying to achieve a soft landing, which is interpreted as interest rates are elevated, but inflation goes down and the economy holds up pretty well, versus a hard landing, which, generally seems to mean, interest rates go higher, but not without the economy taking a pretty serious hit. What do you think needs to happen in the economy for the Fed to be able to get to a point where inflation starts to go down, but the economy is still holding somewhat strong?
That's a tricky question because we don't have many examples of it. In fact, we may not have any examples of it. It is possible that this is all some weirdness due to the pandemic. And as the things normalize vis-a-vis the pandemic, although what exactly the new normal will be is anyone's guess, that the inflation will go away. That's possible. Historically, that's not what's happened. It's required a deep recession to bring inflation down by a meaningful amount. And historically, there's not a lot of other tools the Fed has other than causing a deep recession.
And when it comes to how well equipped the economy might be for this, inflation has obviously been quite high for a while, but the unemployment rate's at 3.6%, which is just a tenth of a percentage point above where it was before the pandemic. And a lot of other measures of the economy, consumer spending has been pretty resilient. How much of a comfort is this to you as the US gets into this hairy period where we're looking at higher recession risk and higher interest rates?
Look, a recession is always a possibility in any economy. I'm not unusually worried about a recession over the next year. Consumer spending remains very high. Businesses are still rebuilding their inventories. There's more workers who are still coming in from the sidelines back into the labor force and into the job market. So, while there's definitely a bunch of risks and a bunch of problems out there, I'm more worried at sort of a horizon of 1 to 2 years than I am at the horizon of 0 to 1 year.
And speaking of the economic outlook, looking a little bit broader too, the US is not the only country dealing with high inflation right now, but the US economy seems to be far better than a lot of other countries that, are also dealing with this inflation, given, the speed of our recovery. What went right in America that, has not helped other economies recover as quickly as we have?
Yeah, look, by any stretch, the recovery has been fast everywhere in the world. It's been faster in the United States. By any measure, inflation has been high everywhere in the world, but it's been higher in the United States. And those two facts are related. We did a much bigger policy response. We got more GDP. We got more inflation. You can debate the relative magnitudes of the two. I think we did too much and got the wrong end of the bargain. But definitely, I think we got more of both.
And, when it comes to how we get out of the situation too, in terms of the inflation, we've talked a little bit about what the Fed can do, but there's also intense political pressure on the Biden administration to try to tackle these prices. And the fact that they're going up so quickly. There's been a few different proposals released by Democrats, most of which, targeting corporations, maybe trying to prevent them from raising their prices too quickly or imposing taxes to counteract that. How effective would any of those strategies be at fighting inflation? And is there anything the Biden administration could do to help bring down price pressures?
There's not a lot that the Biden administration can do. They've done many of the things they can do in terms of addressing the supply side of the economy, trying to help out with ports and getting truckers on the road and the like. I think there's a little bit more they could do, of which dropping the Trump China tariffs are the biggest tool, but that itself wouldn't make a huge difference. The congressional legislation on effectively price controls would be really damaging to the economy. Historically, price controls don't actually help inflation very much. People maybe try to raise prices a lot before the legislation comes in, or maybe temporarily don't raise them so much, but then raise them a lot whenever the legislation ends. So price controls we've tried before. They're a route to large-scale shortages, and they don't solve the problem. Look, it's painful to say, but in some individual markets, the best cure for high prices is high prices. That's what will elicit additional supply. That's what will solve the problem. You try to get in the way of that, and you're just going to create more problems for yourself and more shortages.
Sure. Well, Jason, thank you so much for joining us today. That's unfortunately all the time we have, but I really appreciate you taking some time to help us understand this complex economy.
Thank you.
That brings us to the end of our program. A big thank you to the American Bankers Association for all its support, and to all you attendees for joining us for this discussion. For those of you who missed any of the conversations, we will have video up from the event on our website shortly. I'm Sylvan Lane. Stay safe.